Let's talk in a little more detail about AMC here. We're joined by Chad Beynon of Macquarie. Chad, how do you put in today's equity raise in the context? I mean, you have a company here that's gone from about 100 million shares outstanding a year or so ago to 500 million. They've added more debt. So there's a lot of capital behind this business, which is still a challenge. So how do you evaluate it?
Sure. Thanks for having me. It's obviously a difficult one here. Adam Aron, the CEO of AMC, he's stared death in the face several times at different companies, and I think he's really just embracing what's going on in the retail market. From our perspective, from a valuation standpoint, we look at these as, somewhere between 10 and 15 times free cash flow businesses. So from a fundamental standpoint, we look at what AMC did in 2019. We do think they can get back to those EBITDA or free cash flow levels. The equity raise that they've done in the past couple of weeks, that'll help them potentially bring down the deferred rent and reduced interest expense. But we think they can get back to somewhere between 50 cents and $1 of free cash flow. So then we value the stock off of that.
So you were saying about 10 or 15 times free cash flow, so $10 to $15 a share. Is that what it comes to?
We're constantly reevaluating. This weekend was obviously a big, due diligence weekend to just make sure that demand is still there. But that's generally how we think about movie theater stocks, how we have in the past. I've covered this company in the sector for over 10 years, and that's historically how the sector has traded. And if you look at the comps, whether it's Cineworld, Cinemark, IMAX, or Reading or Marcus, they're all still in that tight band of roughly 10 times free cash flow. AMC has been the one that has broken out from that. So it's tough to tell if there will be a re-rate upwards with the other ones or downwards from AMC.
When do you see them getting back to those free cash flow numbers, in 23 or next year?
For 2022, we're expecting 4% admission revenue decline versus pre-pandemic levels. And as a reminder, actually ahead of COVID, the 9-month trailing admission revenues were almost flat compared to record levels. So heading into the pandemic, we were actually seeing really good visitation to theaters. So we expect this to be the case in 2022. There's a slew of movies, obviously, that we all know about that are just kind of waiting to be put in these theaters. The film rents and some of the other intricacies. Obviously, inflation has hurt the expense for these companies. That'll probably delay it maybe another couple quarters. But in 2022, 2023, we do think they can return to peak free cash flow.
Hey, Chad, two things. One, there was Adam Aron's tweet about this not being a mindless dilution. And then there was the headlines about it, the funds being used to enhance the consumer appeal of theaters, to acquire other assets and leases. I just wonder, when you are competing with big TVs at home and streaming convenience, can a better theater experience be bought?
I think so. The proceeds, three items that Adam could address here. One, grow the business. There are some, bankrupt or near bankrupt theater companies that just didn't have this availability of capital. So he would potentially act on that. Secondly, they have $450 million of deferred leases with some of the big landlords in the theater industry. That's something he wants to address. And then thirdly, as you talked about, they still do have a lot of conventional debt. We'd like to see them, bring those levels down and look at the company on a lease-adjusted basis. So I think if he's able to grow the business by buying some of these other assets, we will obviously get the synergies from reducing the G&A from those corporate offices. There's not much in terms of synergies beyond that. I would like to see them potentially, just address the leases, address the conventional debt versus growing the business. But those are the three items he's talked about with this equity raise, or if the $500 million share is approved in July.
Chad, on that equity raise, I mean, I don't know if you were listening. I haven't spoken to Mr. Mudrick directly, but my expectation is that they're benefiting on the other side of the balance sheet or in a different part of the capital structure. I mean, is there any reason you could imagine for just buying straight equity at this level?
Certainly, I think, being on both sides of the capital structure, like a fund like Mudrick, gives them several options. I think Adam has been in discussions here with lots of their investors, and frankly, he said that 85 to 90% of the current investors are retail investors. So to have someone come in, being helped on their position on the debt side and then benefit on the equity side, it feels like it was, kind of a very unique situation, to say the least.
Shepard Smith here. Thanks for watching CNBC on YouTube.